Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Raymond James Financial stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 20 billion market cap. They're trading at $96 a share and they have 208 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. I pulled their financials from Yahoo Finance, but later on in the video, we're going to look at their most recent quarterly earnings, straight from the company's website. So we'll go through the financials line by line. It's a lot easier looking at the financials for a manufacturing company than say a bank. It's a bit complicated, a bank's financials. But when we pick apart their income statement and balance sheet, I think it'll make a lot more sense. These numbers right here are just the high level numbers. Free cash flow could be a bit wonky. It could be up and down, especially for a bank or insurance company. Companies that add a lot of debt. Really solid free cash flow in 2021. Really weak in the trailing 12 months. But it could be a timing thing. They may be borrowing a lot to fund some loans, and next year we're going to see a big positive when people pay off those loans. Net income is the profit or loss on the income statement. It's revenue minus expenses. In their case, interest income and fees minus expenses. And that's fairly steady. It goes up nicely from 800 million to 1.7 billion. Revenue is the sales for the company. The way most banks make money is on the interest spread. So when you put money into a bank, they pay you, say, 1%. And the bank takes that money and lends it out to someone and charges them 7, 8, 9% on that loan. So the difference in interest rate spread is how they make money. That's the main way. They also make money from fees. Revenue looks pretty good, 8 billion to 9.6 billion to 11 billion to over 11 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 23 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $20 billion. We divide that by 208 million shares. And we get a calculated stock price of $97. They're trading at $96, so they're trading at a 1% discount. It's a small buy according to the model. This is just one way to value a company, and it's probably not the best way to value a bank. Most people like to look at the price to book or tangible price to book in order to value a bank. There are 59 companies in the same industry as Raymond, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. So banks don't spend that much in CapEx. They do spend more than the median average. Morgan Stanley spends the most, 1.6 billion. They have a good debt to equity ratio, 0.3, better than the median average. They pay a dividend similar to the average. Look at Lazard, 6.8%. Morgan Stanley also pays a good dividend, 4.3%. A big negative in free cash flow. Goldman Sachs is the highest at 34 billion. The average and median is negative. They're the 4th largest company on this list. Morgan Stanley is the largest, then Goldman, then Schwab. Price to book is probably the most important stat when looking at a bank. And they're between the median and average. Look at Goldman, they're under 1. That's a really good price to book. You could also look at PE for a bank. They have a good PE. Price to free cash flow and price to sales probably don't matter too much for a bank. They generate a lot more revenue than the median average. Morgan Stanley's the most at 54 billion. And they're still growing. Their 5-year annual revenue growth rate is 10%. Look at Freedom Holdings, 79%. That's really high. I wonder if they took over a bank that went into receivership. That's why their revenue growth looks so high. Let me know in the comments. Let's take a look at their most recent earnings report. These financials are through 6/30/2023, their 3rd quarter. They had record net revenue of 2.9 billion, up 7% from the prior period last year. They have $1.28 trillion of assets under management. A lot of that is the money people put into their savings and checking accounts. They had record net revenue of 8.57 billion and record net income. That's 1.3 billion. Their annualized ROE is 17.9%. ROE is net income over equity. Equity is on the balance sheet. It's assets minus liabilities. Let's look at their income statement. Total revenue is 3.3 billion. That's up quite a bit from last year, up a little bit from last quarter. The percentages are right here. It's up 19% from last year, up 4% from last quarter. Most banks report net revenue. That's after the interest expense, what they have to pay in interest. So their net revenue is $2.9 billion. Here's a breakdown of net revenue. Before we go over this breakdown, they show another breakdown. Of the $2.9 billion of revenue, most of that is from private client group, $2.2 billion. The second most is bank revenue, $500 million. Bank revenue is up 86% from last year. It is down 5% from last quarter. Let's go back to the income statement. Let's look at a breakdown of the $3.3 billion of revenue. $1.4 billion is asset management and related admin fees. Say you have $100,000 and you're not comfortable investing it, you can just give it to Raymond James and they'll invest it and charge a fee. That's what asset management is, along with other things as well, but that's the main thing. So Raymond James is not a traditional bank like JP Morgan. I guess you could think of them as more of an investment bank. The second largest revenue generator is interest income. And here's a breakdown of the $987 million of interest income. $70 million of that is cash, and they earn 5% on that cash. They're a financial institution, so they can earn a lot more than we can on cash. The biggest number is securities-based loans, $250 million. They earn 7% on that. It looks like they earn about 7% on most of the loan products. Commercial and industrial loans, commercial real estate. Residential mortgage loans have a low rate, 3%, because those are secured loans. If you get a mortgage through this company, then your home is collateral for the loan. So that's why the interest rate is lower. Investment banking, $151 million. Fees, $260 million. And then, of course, they have lots of expenses. Payroll is the biggest one, $1.8 billion. Then they have to pay rent for their locations. Business development, $66 million. Professional fees, like accounting services or legal fees, $35 million. They have to post credit losses, $54 million. They have to assume a certain percentage of their loans will default. Their expenses are $2.4 billion, net income of $369 million. EPS of $1.75, which is higher than last year of $1.41, but lower than last quarter. It was close to $2 last quarter. They are decreasing their shares outstanding. They had 214 million last quarter. They're down to 210 million. They also had 210 million last year. So they're only down about 600,000 shares from last year. Let's take a look at their interest earning assets. They have a total of $72 billion of interest earning assets. The biggest one is securities-based loans, $14.5 billion. They earn 6.5% on those loans. So they lent out $14.5 billion at an average interest rate of 6.5%. Some people pay 10%, some people pay 3%, depending on a lot of factors. The average interest they earn is 5%. Where do they get all the money to fund these loans of $72 billion? That's down here in their liability section. They have $64 billion of interest-bearing liabilities, $43 billion from money market and savings accounts, $8 billion of high-interest savings or checking accounts. These pay 4.5% interest. Then you have $2 billion of CDs. So $64 billion is given to the bank in some form. They pay 1.9% interest. And they take that money and lend it out and receive 5% interest. You can see 72 is higher than 64. So lots of financial institutions borrow from the government if they need to fund those loans or fund their operations. Let's take a look at the company on Simply Wall Street. Its last price was $96, $20 billion market cap, down 3.5% in the past week, down 5.4% in the past year. Let's learn a little more about the company. Raymond James is a diversified financial services company that provides private client group, capital markets, asset management, banking, and other services to individuals, corporations, and municipalities in the US, Canada, and Europe. The private client group segment offers investment services, portfolio management services, insurance and annuity products, and mutual funds. They also provide support to third-party product partners, including sales and marketing support, as well as distribution and accounting and administrative services, margin loans, securities, borrowing and lending services, and custodial, trade execution, research, and other support and services. The capital markets segment provides investment banking services, including equity underwriting, debt underwriting, and M&A advisory services, and fixed income and equity brokerage services. The asset management segment offers asset management, portfolio management, and related administrative services to retail and institutional clients. and administrative support services such as record keeping. The bank segment provides insured deposit accounts, commercial and industrial, commercial real estate construction, tax-exempt residential mortgage, securities-based, and other loans, loan syndication services, and liquidity management products and services. The other segment provides private equity investments, including investments in third-party funds. They were founded in 1962, headquartered in St. Petersburg, Florida. Here's the stock price since 1990. It looks like they were trading at 62 cents a share in 1990, but the reason it's so low is because it's stock split adjusted. In 2007, it was over $20 a share, and then it looks like it crashed from the Great Recession. It fell to $10 in 2009. Let's look at the past 5 years. It's a lot easier to look at. It was 66 before COVID hit, then it bottomed out at about 37. Its all-time high was at the end of 2022, $124 a share. It came down to the low 80s. That was just a few months ago in May 2023. It has come up since then to over 110, but it's down about 10-15% from that price. Simply Wall Street's valuation is 138. They say the stock is 31% undervalued. 11 analysts priced this stock at 118. They also say the stock is undervalued. The revenue forecast for 2026 is $14 billion, $13.4 billion for 2025, and $12.4 billion for 2024. When I do my DCF, this is how I get the future revenue estimates from Simply Wall Street. And Simply Wall Street gets the info from analysts. There's one analyst forecast in 2026, $14.2 billion. There's 9 analyst forecasts for 2025 for $13.4 billion. This is their revenue since 2012. It was $4.1 billion then. It pretty much goes up every single year. It doubled to over $8 billion by 2021. It's currently $11.2 billion. This red line is their debt since 2012, and it's usually between $2 and $4 billion, but they always have a lot more equity than debt. Their debt to equity ratio is 37%. And if you look at their cash, they have a lot more cash than both their debt and equity. Their dividend yield back in 2013 was 1.3%. It peaked in 2020 at 2.2% because the stock price came down. When the stock price goes down, the yield goes up. The forecast is 2.2% by 2026. Paul Riley has been CEO for a little over 13 years. His salary is $687,000 a year, total compensation $18 million. In the past year, there's been only insider selling, no buying. 77% of the companies held by institutions, 13% by the general public, and 10% by insiders. The biggest shareholder is Vanguard. They own 11% of the company. Thomas James is the second biggest shareholder. He's the son of Robert James, the founder. The reason the company is called Raymond James and not Robert James is because Robert James had an investment company that merged with another company called Raymond and Associates. So they took Raymond from the predecessor company and Robert James's last name, James. So Raymond James. Thomas James is chairman of the company. He's been with the company over 40 years. BlackRock is the third biggest shareholder, 8.25%. Then you have State Street at 3.86%, JP Morgan 3.5%, Northern Trust 1%, the Norwegian bank Norges Bank 0.9%, the Dutch pension fund Stichting, they own 0.78%, Invesco a little over 0.5%. They employ a good amount of people. It was only 10,000 in 2013. It's up to 17,000 currently. The ticker trades in a lot of places: the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.